Welcome to the Deep Dive. Ever look at a new park or, say, a convention center and wonder how it actually got paid for?
Yeah, like where did the money come from? How did they track it all?
Exactly. So today, we're jumping into capital projects funds in governmental accounting.
Mm-hmm.
Think of it as, well, getting the inside scoop on the finances behind those big community builds.
Right. We're pulling from materials that explain the accounting rules here, the mission, to really get what these funds do, how they're funded, and, the specific ways they're accounted for.
Okay, so capital projects funds, what are they, basically?
Well, they're specifically set up to handle the money for building or buying major long-lived assets, stuff used by the main governmental operations.
So not things like a city-owned water company or the pension fund?
Correct. Those have their own fund types. Capital projects are for assets supporting the core governmental services, the GRAS-PP funds, if you remember that acronym.
And a key thing is they're temporary, right? They don't just go on forever.
That's a crucial point. They usually only exist for the life of the project, maybe 1 to 3 years. Once the convention center or courthouse is built, the fund often wraps up.
Makes sense. So examples like building that convention center or maybe a new stadium or even streets where homeowners nearby benefit and maybe pay a bit extra.
Those are perfect examples. Streets, streetlights, that sort of thing, funded by special assessments fall under this too, depending on the government's liability for any related debt.
Okay, funding. Where does the actual cash originate for these projects? Is it just taxes?
Often, the biggest chunk comes from issuing bonds. Basically, the government borrows money specifically for that project.
And that bond money is restricted.
Absolutely. It's usually legally tied only to that specific capital project. You can't just use it for salaries or something else.
What else? Any other sources?
Oh, yeah. You might see transfers coming in from, say, the general fund, or maybe a special revenue fund that collects a specific tax for a development. And capital grants are common too. Maybe from the state or federal government. Sometimes these have strings attached, affecting when you can actually count them as revenue.
Ah, like you can only recognize the grant money as revenue when you spend it on the project.
Exactly, for restricted grants. Unrestricted ones might be recognized sooner. Also, investment earnings on any cash sitting idle in the fund.
And what happens to those earnings? Do they just stay in the fund?
Often, no. They frequently get transferred over to the debt service fund.
Ah, the fund that's actually responsible for paying back the bondholders.
Precisely. It helps cover the interest payments. And back to those special assessments on property owners?
Yeah?
How they're accounted for depends. If the government is primarily or potentially liable for the debt tied to the project, the money from owners is shown as a contribution in the governmental fund.
But if the government isn't liable?
Then it's often handled through a custodial fund. The government is just acting as an agent collecting and passing on the money. Less direct involvement.
Got it. So when those big bonds are issued, how does that look on the books for the capital projects fund itself?
Good question. The main amount, the face value of the bonds, shows up as an other financing source. It's not revenue, but it's cash coming in.
What if they sell the bonds for more than face value, like a premium?
That premium is also an other financing source. If they sell for less, a discount, that's shown as an other financing use, reducing the net inflow.
And unlike in business accounting, they don't spread that premium or discount out over time.
Nope. Not in these governmental funds. The focus is on the current financial resources. Bond issue costs, like lawyer fees, are just treated as debt service expenditures when they happen.
Okay, so the money's in the fund. How do they track the spending? Encumbrances, right?
Exactly. Encumbrances are key. When the government signs a contract or issues a purchase order, they encumber the funds. It's like putting a hold on that part of the budget.
So it reserves the money.
Precisely. It prevents overspending. Then, when the actual invoice comes in and gets approved, the encumbrance is reversed, and the real expenditure, usually capital outlay, is recorded along with the payable.
And this capital outlay is the cost of actually building or buying the asset.
Yes. But here's a really important point. The value of the asset being built, the construction in progress, it doesn't show up on the capital projects fund's balance sheet. That asset belongs to the government as a whole, tracked in the government-wide statements.
Okay, that's a critical distinction. And the bond debt itself isn't here either.
Correct. That liability lives in the government-wide statements and is managed payment-wise usually by the debt service fund.
What about short-term borrowing? Like if they need cash before the bonds are sold.
Ah, bond anticipation notes. If they expect to pay those back with the actual bond proceeds, they're treated like another financing source in the capital projects fund.
But if it's more like a tax anticipation note paid back from taxes?
Then it's just recorded as a current liability in the fund that borrowed it. Different expectation, different accounting.
So at year end, how do they, close the books for this fund?
It involves a few closing entries. Basically, you close out the budget figures, then you close out the actual revenues, expenditures, and those other financing sources like bond proceeds and transfers.
And what about any outstanding encumbrances? Those holds on money for contracts not yet finished.
Good point. Those get closed out too, but the amount is carried forward into the next year as part of the fund balance, typically labeled as restricted or committed fund balance. That money is still earmarked.
So the fund balance would show what's left, specifically set aside for the project.
Exactly. If you look at the balance sheet, you'd see assets, mostly cash or receivables, and then liabilities and the fund balance, often restricted.
And the other main statement.
The statement of revenues, expenditures, and changes in fund balance. It shows the income, the capital outlay spending, and how things like bond proceeds and transfers affected the fund's bottom line over the year.
You mentioned earlier how funds work together, like for that convention center example.
Yes, it's common. You might have a special tax collected in a special revenue fund.
Which then transfers money to the capital projects fund for construction.
And maybe also transfers funds to the debt service fund to help pay the bonds issued by the capital projects fund. They're all interconnected. Transfers out of one fund must equal transfers into another.
Okay, one last thing. How do permanent funds differ from these?
Permanent funds are quite different. They're used when the government receives resources, often donations, where the rule is that the original principal amount must be preserved forever. Only the earnings, like interest, can be spent.
Oh, like an endowment for maintaining a public cemetery?
That's the classic example. The principal stays untouched, legally protected, and the interest earned is used for, say, upkeep. They generally don't use encumbrances either.
So the key difference from a special revenue fund is that restriction on the principal.
Exactly. A special revenue fund might let you spend both principal and interest if the restriction allows, but a permanent fund protects that principal. Interest only for spending.
Got it. So wrapping up, capital projects funds are these specific temporary vehicles for financing and tracking major government construction or purchases, funded mainly by bonds, and using that modified accrual current resource focus accounting.
That sums it up well. The accounting reflects their specific purpose and short lifespan.
So thinking bigger picture then, how does understanding this life cycle of a capital projects fund give you, the listener, better insight into a government's long-term plans or financial health? What might you ask when looking at these reports?